Now, it's time for us to gather all the balances from our T accounts and list them in the trial balance in the following order from the top: asset, liability, capital, revenue, and expense. If your prof is quite meticulous, then you might want to further arrange the expense accounts as number 1, general and administrative, 2, selling and distribution, and number 3, financing or finance cost or expense. Then sort each expense category further from the highest to lowest amounts. For some teachers, it's okay to just sort the expense accounts by amount, or some really don't mind. For as long as you list them all, it's fine. So this is how it looks like. At the top, we have the name of the company, the name of this list, and then the date. Then we have the account titles over here and the debit or credit balances over here. This is just plain listing of accounts with balances. Those with zero balance did not appear here. At the bottom, we have the total. It's named trial balance for a reason. We have to make sure that the total debits equals credits. Detailed structured discussion about adjusting entries is in separate videos or presentation. Items for adjustment here is intentionally made simpler just to facilitate the illustration of this complete accounting cycle. Quick recall: adjusting entries are made to update and or correct the unadjusted account balances. Now let's assume the following are subject to adjustments. We have here A to G. Okay, I will just include this picture here. Now let's prepare the adjusting entry for each. For A, Forever Young has earned the revenue already, although it is not yet paid and at the same time not yet recorded. Do you remember what type of adjustment is this? This is under the accrual of revenue. So the adjusting entry will be, and since we are using the perpetual inventory system, we have to create another entry again. For every sale transaction, we need this extra entry. For letter B, remember that the assistant started working on Monday, September 28 with a 400 daily wage rate to be paid every Friday, but the end of the month falls on a Wednesday. That means 3 days of the wage must be included in our accounting report even if it's not yet paid. So that's an accrual of expense on the part of Forever Young. Our adjustment will be, okay. For C, since we use the expense method, meaning we recognize all of the 15,000 as a rent expense when Forever Young paid for it, then that makes the rent expense account overstated or sobra. Because the expense is only for the month of September, that's why we need to decrease rent expense by 10,000, which is also equal to the 2 months unused rental payment. So record the unused rent as an asset using the account prepaid rent by debiting or increasing such for 10,000, then crediting or decreasing rent expense for the same amount. Remember again the rule: to increase, follow the normal balance of an account. To decrease, just do the opposite. In case you're still wondering, both prepaid rent and rent expense account have a normal balance of debit. For D, this is just the same concept as letter C, but here it is already stated how much is the unused. So automatically, that's the amount we're going to debit as an asset because again, we initially recorded the payment using the expense method. Now, letter E is the case of consumed utilities but not yet paid and recorded. Does it ring a bell? Yes, of course, it's the accrual of expense again. So the adjusting entry will be For F and G, we don't have to analyze and compute anymore because the amount for bad debt expense and depreciation expense is already given. We just have to record both by debiting the accounts and then crediting allowance for bad debt for F and accumulated depreciation for G. Both the allowance for bad debt and accumulated depreciation are contra asset accounts with a normal balance of credit, meaning by crediting, we increase the accounts but the effect in asset is a decrease. Allowance for bad debt is still under asset, it's just that it decreases the accounts receivable account. The same is true for accumulated depreciation. It is still part of asset but decreases the depreciable long-term asset, like in this case, the furniture and fixtures. Detailed explanation involving bad debt and depreciation is in separate videos. Accomplishing worksheet is an optional step as we can move to the next even without preparing this worksheet. Some teachers call this as a scratch paper. This is meant to facilitate the preparation of adjusted trial balance and the financial statement. But have you noticed? It usually is such a pain in the ass to prepare. Anyway, here it is. The heading and this column stretch until here. Actually, instead of preparing a separate unadjusted and adjusted trial balance, we can just prepare both in this worksheet. So, we have here the account title, the unadjusted trial balance, the adjustments column, the adjusted trial balance, and the preliminary profit and loss statement, also known as the income statement, and the statement of financial position, which is also known as the balance sheet. Disclaimer once again, some instructors have a slight variation in preparing this. I'll explain later, but I prefer it this way as it serves the main purpose of the worksheet. So we start with copying all the unadjusted accounts and the corresponding balances from the T accounts we prepared earlier, except those with zero balance, of course. Or if we have a separate unadjusted trial balance, we can just go ahead and copy that here. Then let's reflect here the adjusting entries we made. Observe the following. You may add new accounts below as necessary, then get the total. After this, let's update the accounts with adjustments under the adjusted trial balance column. Observe the AR with 25,000 balance in the unadjusted trial balance and a debit or increase in the adjustment column. And now, it's 40,000 in the adjusted trial balance. Then merchandise inventory, 51,575 minus 9,375 because of the credit in the adjustment column. So the new balance will be 42,200. Do the same for the rest of the accounts with adjustment, and for those accounts that don't have adjustment, the amount stays the same. To be successful in this part, just keep in mind the normal balance of each account. We have a separate video also for this one. Now it's time to forward the accounts to either statement of profits and losses or to the statement of financial position column. All assets, liabilities, and capital accounts go to the statement of financial position, while revenues and costs or expenses go to the statement of profits and losses. Take a look at this. From cash to drawing, forwarded here, again still following the normal balance of an account. Then, from sales revenue to freight out, goes here. Now let's see if you can classify the remaining accounts properly. Okay, I'll give you a few seconds. Let's classify the remaining. Okay, done. please check against this classification here. Okay, then get the total again for each column. They're not expected to balance. So for profits and losses, if the credit side is higher, then that's income. So put the difference between these two in the debit side under the total. However, if the debit is higher, then that's a loss. So put the difference between these two in the credit side under the total. For financial position, try to balance the debit and credit side by placing the balancing figure on the side with the lesser amount. Now observe that the balancing figure for both statements are exactly the same. Here's a bonus. If this amount is far from each other, that's net income. Pretty much like if your jowa is an OFW and you're in LDR, each of you tend to earn more. So abroad ang jowa, LDR kayo, daming kita. But if both are sitting next to each other, that's a net loss. Parang kayo ng crush mo, laging magkatabi. Panay landi, ending, bagsak kayo parehas. Finally, everything is balanced on to the next step.